quickly understand share repurchase as one of the final topics of today. So let's go very quickly to our Excel file and understand share buybacks. I'm taking the example of Infosys, the Indian company, and this should help us understand things. So you could buy back shares, which is effectively buying back shares from the market using your money that you have on the books or borrowing money. So I've taken two examples, a buyback with own money. They have 25,000 crore of cash, which they are using to buy. And we will say that, let's say they buy back using borrowed money. We'll look at that concept later on. Now, before the buyback, they have 57.42 crore shares or 574 million shares outstanding. Their net profit is 9,200 crore or 92 billion effectively rupees, Indian rupees. Market capitalization is given as this, let's assume, and you get the stock price, you get the earnings per share based on the calculations. They have 25,000 crore of cash on their books. So effectively, let's assume they're using half of this. If they're using half of this, 12,500 crore at this market price, they will get 4.31 crore shares. After buyback, number of shares go down. If they have used their own money, and let's assume this was idle cash, profits will not change. If they were earning some money on this cash, let's say 2% return on this cash, then profits will go down by that number. Your EPS will get calculated based on the new number. Straightforward. Buyback using borrowed money, however, will render your profits lower, because if you borrow 12,500 crore at an interest rate of 7%, you will end up paying an interest of 875, which reduces your net profit by 875. It is possible that after the buyback, the earnings per share actually goes down from the existing number because profits have gone down in order to fund the purchase. So that's one thing that you need to be careful about in terms of looking at buybacks while looking at companies. Fine. The next bit that is important in terms of understanding buybacks is looking at what happens to effectively, so there are various share repurchase methods. You could have open market, which is buy in the market. You could buy a fixed number of shares at a fixed price. You could have a range of acceptable prices, which is called a Dutch auction. Or you could repurchase by direct negotiation with a shareholder, a specific shareholder repurchase with a direct negotiation. Understand these concepts, they could be used somewhere. Now, effect of share repurchase on EPS. We have already seen EPS usually goes up, but if cash was earning returns, then outlook may not be very clear. EPS would go up only if cost of funds is lower than the earnings yield, otherwise it would go down effectively. The final point, which is an important concept that comes again and again, is to understand the effect of share repurchase on book value per shares. For that purpose, we have taken two companies, 100,000 shares outstanding for both. Book value per share is different because book value is different. Stock price in the market is the same, $20. You are buying back 25,000 shares out of the 100,000 shares, which means shares after the buyback is 75,000. Amount used for buyback will be 25,000 multiplied with the market price. So 25,000 into 20, which is 500,000. That's what you have used for buyback. The moment you have used for buyback, your book value will go down by this amount. Correct? So your book value becomes 1 million minus 500,000, 3 million minus 500,000. Now, when you calculate book value per share, you note that for the first company, book value per share goes down. For the second one, it goes up. So the relationship is effectively that if a company has market price greater than book value per share, then book value per share declines after the buyback. If the market price is less than book value per share, then book value will increase after the buyback. And it's actually intuitive to understand this. Effectively, what happens in a buyback is that these 25,000 shareholders are getting the money, this book value, which was entitled to these 75,000 shareholders as well. So effectively, if the book value per share is lower than the market price, these 25 guys, 25,000 shareholders benefit at the expense of the other guys, because their cash got distributed to the other 25,000 guys. So effectively, they will end up with a lower book value per share after the buyback. On the contrary, there are other guys here. In this case, because book value per share is higher and you end up buying back the share at 20, you are saying that these guys actually suffered and these guys benefited, which means at the end of the entire exercise, you end up increasing the book value per share for the remaining shareholders. Fine. Important concept, which usually keeps getting asked once in a while. So just be careful and understand this. You could be given a question of, if this is the book value and this is the market value of the stock, what will happen to book value after a buyback? Fine. If we can wait for another 5 to 10 minutes, we will talk about